Welcome back to the show. Today, I want to start with a number that should be impossible to comprehend and a feeling that almost everyone listening to this is going to recognize. Entering 2025, the net worth of the entire world hit a staggering record, $600 trillion. If you divide that across every human being on the planet, it comes out to roughly $75,000 per person. On paper, that sounds great. Humanity is richer than it has ever been in recorded history. But here is the catch, and frankly, the reason we are doing this briefing today. If you are listening to this right now, you probably do not feel 4 times richer than you did back in the year 2000. You aren't crazy. The data backs you up. Since the turn of the millennium, global GDP, the actual tangible economic output of the world, the value of everything we collectively produce, only grew by about 40%. Just 40. But in that exact same 25-year window, global wealth grew by nearly 400%. 4 times the asset growth as the underlying engine that produces value. That is a historic, unprecedented disconnect between the economy's actual engine and the skyrocketing prices of the assets sitting in our portfolios. That widening gap is the defining economic story of our time. And today I want to walk you through exactly what the world's $600 trillion balance sheet is actually made of. Because once you see the composition, the scoreboard, and the actual game being played on the field, stop looking like the same thing. We're going to pull reports from McKinsey, UBS, and S&P. We're going to look at the genuine utility of asset values and the structural fragility hiding underneath them. And at the end, I want to leave you with a single piece of data about the next 25 years that I think reframes the entire conversation. Let's get into it. Before we go any further, we need to make a basic distinction that gets confused in almost every headline you read about wealth and the economy. Think of GDP, gross domestic product, as a country's income statement. It is the flow of new value being produced, the wages, the goods, the services, the actual game being played on the field. Wealth, on the other hand, is the balance sheet. It's the vault. It's the accumulated value of everything we own. Homes, stocks, bonds, businesses, land, the scoreboard. In a normal economy, those two move roughly together. When the game is going well, the score goes up. When the game stalls, the score stalls. What we have been living through for 25 years is something different. The scoreboard has been racing 4 times faster than the game. Now, to be perfectly balanced here, I want to acknowledge that a rising balance sheet does have real-world utility. It's not all illusion. High asset values generate deep consumer confidence. When households see their home equity rising, they feel secure enough to spend. And that keeps the economic engine humming. Even more importantly, high asset values act as collateral. A family with a highly valued house can borrow against that equity to start a small business or fund higher education. That collateral fuels actual economic mobility. So a skyrocketing balance sheet sounds like the ultimate economic golden ticket. The catch is structural. If the balance sheet outruns the actual economy, if the price of the things we own keeps going up, while what we produce flatlines, we are not creating prosperity. We are inflating a giant bubble and calling it prosperity. Capital stops flowing into research, new factories, infrastructure. It just endlessly chases the assets that are already built, pushing their prices higher and higher. Here's what this means for you. Just because your house's estimate went up by $50,000 this year does not mean your community is fundamentally richer. No new roads were paved, no new hospitals were built. The scoreboard flipped to a higher number based on market sentiment. That's worth holding on to as we get into the numbers. Let's do the grand tally. When you take the entire planet and put it on a single balance sheet, what are we actually made of? If you sum every asset on Earth, the gross number is roughly $1.7 quadrillion, quadrillion with a Q. But in any financial system, one person's asset is almost always another person's liability. If you own a corporate bond, that bond is your asset, but it's a debt obligation for the corporation that issued it. Your savings account is an asset to you, but it's a liability on the bank's ledger. So when you consolidate the entire global balance sheet and cancel out all that financial paper, the derivatives, the bonds, the loans, you are left with the net real wealth of the world. And that sits right at about $600 to $620 trillion. Now here's where it gets surprising, because we are living through an absolute digital revolution. Artificial intelligence, massive data centers, software ecosystems, intellectual property. I would have guessed a dominating chunk of that real wealth is cutting-edge technology. We talk about ourselves as a cloud computing species. The actual number is a slap in the face. Roughly 2/3 of the world's net real wealth is real estate. It's dirt, houses, and apartment buildings. Read that again. 2/3 of everything humanity is supposedly worth is the ground we stand on and the boxes we live in. Meanwhile, all the intellectual property, the software, the cutting-edge tech that we obsess over, it accounts for less than 5% of global net worth. Sit with that for a second. We view ourselves as a highly advanced AI-driven civilization, but when you look at the actual balance sheet, we are essentially feudal lords with a smartphone attached. We are a giant real estate portfolio that happens to use chat apps. Here's what this means for you. Despite the constant noise about tech billionaires and the digital frontier, the vast majority of global wealth is still tied up in the physical dirt beneath your feet and the roof over your head. If you're trying to position yourself for the next decade, the asset class that drives prosperity is still and will likely remain the most boring traditional one. Which brings us straight to the obvious math problem. If the world's wealth is mostly just houses and land, how on earth did it quadruple in 25 years? We definitely did not build 4 times as many houses. We definitely did not discover 4 times as much land. The planet did not get bigger. The growth did not come from volume. It came from valuation. We experienced a massive systemic inflation of asset prices, largely driven by central bank policies, historically low interest rates, and a flood of cheap debt. Same houses, same dirt, dramatically higher prices. The mechanism is worth pausing on because once you see it operating, you cannot unsee it. Let me give you the 2 analogies I think capture this perfectly. First, picture 2 people standing in a field, trading a shiny rock back and forth. Person A sells it to person B for $1. Person B sells it back to person A for $2. They keep trading, raising the price by $1 each time, using borrowed money to fund each new purchase. The market value of that rock skyrockets. On paper, they have created tons of wealth. But step back and look at the physical reality. Nothing was improved, nothing was built. The rock is still just a rock. It's pure paper equity, driven entirely by the last price someone was willing to pay. That is asset inflation in its purest form. Capital didn't go toward making the rock better. It went toward bidding up its price. Now contrast that with how economic growth is actually supposed to work. Picture a man with a shovel. With a hand shovel, he can dig a certain size hole in a day. That is his baseline productivity. But if he takes out a loan and buys a motorized excavator, that same guy can dig a hole 10 times the size in the same amount of time. That loan was not used to bid up the price of an existing asset. It was a capital expenditure that fundamentally increased output. He created real tangible value. The economy actually grew. 2 worlds, shovel world and shiny rock world, investing in better tools versus paying more for the same old rocks. The McKinsey data on which world we have actually been living in is uncomfortable. Over the past couple of decades, for every $1 of new real investment, the tractors, the new factories, the research and development, the world created $2 of debt. We borrowed heavily, but we did not use that debt to buy excavators. We used it to flood real estate and stock markets, bidding up the prices of things that were already there. That dynamic perfectly explains the household wealth data. Between 2000 and 2024, global households gained roughly $400 trillion in wealth. Massive number. But when you break down where that money actually came from, the picture changes completely. Of that 400 trillion, roughly 36% was pure paper wealth, the shiny rock price bumps we just talked about. Another 40% was just general inflation, which is simply the money supply expanding and losing its purchasing power, which means less than 30% of the incredible wealth boom of the 21st century came from real investment, from the proverbial man with the shovel actually producing new value. Sit with that for a second. Less than 30%, 2/3 of the wealth we have supposedly created since the turn of the millennium is either price bumps or money supply expansion. Human productivity completely failed to keep pace with asset prices. We did not get 4 times smarter. We did not build 4 times as many useful things. We financialized our economy. We borrowed money and mutually agreed to pay more for the assets we already had. And that fundamentally alters the social contract of a society. When wealth grows through asset inflation rather than productivity, it inherently punishes anyone who does not already own assets. Here's what this means for you plainly. If you are sitting there wondering why your paycheck feels like it is barely treading water while the stock market hits all-time highs, this is the exact mechanism. Your labor is being measured against an asset class that is inflating without producing. When you look at your home's Zestimate or your retirement account, remember, you are largely looking at shiny rock wealth, not a measure of actual new value you or the economy have created. So if this entire $600 trillion global economy is heavily reliant on trading shiny rocks at higher prices, who is actually holding them? Households own about 90% of the world's wealth. The UBS report identifies a phenomenon they call the Emily, the everyday millionaire. These are individuals holding $1 to $5 million in investable assets. There are now 52 million of these everyday millionaires globally, a number that has quadrupled since 2000, largely because they rode the exact wave of real estate and stock market inflation we just walked through. But the everyday millionaire is just the middle of the story. The broader inequality reality is much sharper. Globally, the top 1% owns at least 20% of all wealth. Zoom in on the United States and the disparity is staggering. The top 1% in the US owns 35% of all wealth, averaging about $16.5 million per household. The bottom 50% of the United States holds just $9,000 on average, 16.5 million versus 9,000. That is not an accident. It is the mathematical guarantee of an economy driven by asset inflation. If the entire engine of wealth creation is price bumps on existing assets, then by definition, the people who already own those assets compound. The people who do not own them get left further and further behind every single year. Here's what this means for you. If you don't already own assets, your paycheck mathematically cannot keep up with the inflation of asset prices. This is not about working harder. The math itself is against you. Career strategy in this environment has to include acquiring ownership, equity in your work, in your home, in productive assets, because labor alone is structurally losing the race. The same dynamic is playing out at the corporate level, and the mechanism is called the stock buyback. The S&P report notes that U.S. companies spent a record $1.02 trillion on stock buybacks over a recent 12-month period, over $1 trillion. Here's how it works mechanically. When a company does a buyback, they use their cash to go into the open market and buy their own shares, essentially retiring them. By reducing the number of shares in existence, the earnings per share mathematically goes up, making the remaining shares more valuable. They are financially engineering a higher stock price without building new factories or researching new products. Now you might say, wait, isn't this good for me if it makes my 401k go up? On an individual short-term level, your portfolio statement absolutely looks better. But connect this to the bigger picture, and the dynamic is clear. Wealth is increasing wealth, not productivity. When corporate executives choose to spend $1 trillion on buybacks instead of innovating, capital is rewarding asset holders instead of trickling down to wage earners. Over time, if companies are not heavily investing in the shovels, the real-world value of those shares is not justified by underlying growth. You end up with a higher stock price built on the same business. Here's what this means for you. Watch what companies in your portfolio are doing with their cash. Buybacks are not always wrong, but a company spending its capital primarily on share repurchases instead of R&D, capital expenditure, or genuine expansion is signaling that it has run out of productive uses for money. That is a critical piece of information for any long-term investor. We have built a $600 trillion tower of wealth, largely on price bumps, financial engineering, and massive amounts of debt. It is a balance sheet that is completely detached from its underlying economic engine. So the obvious question, what happens if the wind blows? We have a very clear historical precedent for what a balance sheet reset actually looks like. Japan, late 1980s and early 1990s. Japan experienced a massive asset bubble fueled by cheap debt and soaring real estate and stock prices that entirely disconnected from their real economy. When sentiment shifted, the bubble popped. Paper wealth vanished almost overnight. It triggered a long, painful correction the country took decades to climb out of. Paper wealth can vanish very quickly on a simple shift in market sentiment, and the McKinsey report models the stakes for us today if something similar happens globally. In the United States alone, up to $160,000 in per capita wealth is at stake over the next decade. If the world experiences sustained inflation or a sudden balance sheet reset, U.S. wealth could erode by $95,000 per person in real terms, in purchasing power, because structurally it was never truly there to begin with. Here's what this means for you. A wealth boom built on paper and sentiment is fragile. The numbers you see on your banking screen are highly vulnerable to psychological shifts, not just economic fundamentals. Position your finances with that fragility in mind. The Japan correction took decades. If a global version of that ever lands, the time horizon for recovery is generational, not cyclical. Which leaves us with the obvious question: how do we close the gap between our $600 trillion balance sheet and our actual real-world economic output without triggering a crash? The only painless way out is productivity acceleration. The shovel has to catch up to the shiny rocks. The economy has to grow faster than the debt. We need a massive leap in how much value we actually produce. And right now, looking at the landscape, there is really only one major live candidate that could potentially spark a global productivity boom: of that magnitude, and that is technology, specifically the AI investment cycle. Hundreds of billions are being poured into data centers and large language models. The hope is that this technology will act like the motorized excavator for the modern knowledge worker. But, and this is the critical caveat, for this to actually be our bridge, it has to be based on real productivity gains, not just tech hype. Businesses cannot just claim AI to boost their stock price. They have to actually adopt the technology to become fundamentally more efficient. And the global imbalances that got us here have to correct in parallel. Europe investing more domestically, China consuming more rather than just exporting, the US saving more instead of relying on constant borrowing. It requires real structural rewiring. So here's what this all means for you. Your long-term prosperity depends on businesses actually using new technologies to make work faster, better, and more efficient, rather than just using cheap debt to trade existing assets back and forth. We have to get back to the shovel. I want to leave you with one final piece of data from the UBS report that I think reframes everything we just talked about. Over the next 20 to 25 years, an unprecedented $83 trillion is expected to be transferred from the baby boomer generation to their heirs. Think about what that means. An entire generation that rode the asset inflation wave we just walked through is about to hand the largest pile of paper wealth in human history to a generation that did not build any of it. So here is the question to genuinely sit with. If most of that 600 trillion is just paper, are we really any richer than we were 20 years ago? Or are we just sitting on a bigger number? And when those assets change hands one more time, in the largest wealth transfer in recorded history, what will the next generation choose to do with it? Will they invest in shovels, or will they keep trading the shiny rock? That answer is going to define the next 50 years of the global economy. Thanks for going down this one with me. Pay attention to who's holding the keys. I'll see you on the next one.